There's two new massive mortgage changes coming to Canada that you're going to want to know about. In today's video, I'm going to go over both the new changes that become effective December 15th. Before I get into it today, if you guys could hit that like and subscribe button to help me get my video out to more people like you, I would greatly appreciate it. And if you want to book a 30-minute call with me to talk about more things real estate, you can do so by clicking the link in the description below. Both these new changes brought in by the federal government are aimed to improve housing affordability for Canadians. Let's talk about the first change, and that is increasing the insured mortgage cap from $1 million to $1.5 million. This means that the minimum down payments are changing because anything with 20% down or more is an uninsured mortgage, and any mortgage with less than 20% down has to be insured. The previous rule was that you needed 5% down up to $500,000 and 10% down between the amount of $500,000, $1,000 all the way up just before $1 million. After $1 million, you needed 20% down. And now that minimum 20% down is only applicable if the home is priced at $1.5 million. So if you're buying a home up to $1,499,099, you can still do that first 5% up to $500,000 and 10% between $500,000 and now just under $1.5 million. This could have a big impact on Canada. So right now in Canada, 20% of homes fall between that bracket between $1 million and $1.5 million. So there's going to be a lot of Canadians that are going to have an easier time coming up with the funds to get into a home in that price range. Now, obviously in Vancouver and Toronto, there's a lot more than 20% of homes that fall within that category, and those are the areas that are going to see this change impact the market the most. And that's going to be in terms of sale price and sales volume. I'm going to break down the difference between the down payment needed with the old rules versus the new down payment rules for those homes priced between $1 million and just under the $1.5 million mark. Now, keep in mind these down payments are a lot less. However, that means that you're also going to take on more debt. So just be careful to not overextend yourself. So let's break it down between what the old down payment used to be versus what the new qualifications now are. Previously, a purchase price of $1 million, you were expected to come up with 20% of $1 million, which is $200,000. The new rules of 5% up to $500,000 and 10% thereafter up to just under $1.5 million, you're now only required to put down $75,000. So that's a difference of $125,000, which is a massive amount and could be the difference between someone getting into that $1 million property versus not. $1.1 million now requires $85,000, 1.2, $95,000, 1.3, $105,000, $1.4 million purchase, you'll be required to put down $115,000, and up to $1,499,999, you'll be required to put down just under $125,000. Comparing that to the previous requirements of $300,000, that's a difference of $175,000. Now, keep in mind that they also have to factor in your debt service ratio and credit score, as well as your income. So do take these kind of with a grain of salt, but that is the new down payment requirements in Canada effective December 15th. And this will make the barrier to entry a lot easier than it previously was for Canadians because the down payment amount is a lot less. However, big asterisks, you still will need to qualify. A general rule of thumb is to multiply your income by 4, and that's generally what you should be able to qualify for. Again, that's assuming a good credit score and also taking into account your debt service ratio. In theory, this should increase the number of insured mortgages that we see, so those that are putting less than 20% down. However, I don't know if that's going to be the case because generally people that are purchasing between the $1 million to $1.5 million mark have previously owned something and have built up quite a bit of equity. They may choose to put down that 20% or more to reduce their monthly payments. But in any case, this new rule will make it easier for people to get into the real estate market, given that they're earning a good income and that they have a good credit score, but maybe just are a little short on that down payment. The second change is that they're expanding amortization to 30 years for all first first-time homebuyers and anyone who's buying a pre-sale regardless of your down payment. If you're a first-time homebuyer, it doesn't matter how much you're putting down. You can still qualify for a mortgage with a 30-year amortization, which in turn stretches out the length of your mortgage, and therefore your monthly payments are going to be less. However, the amount of interest you're going to be paying over the long run will be more. Keep in mind, again, this is for first-time homebuyers only. So if you're not a first-time homebuyer, unless you're buying a pre-sale, you still will have to put that 20% down in order to get that 30-year. Otherwise, you're looking at 25 years. These new rules are also aimed at improving pre-sales, so new construction sales by developers that we've seen over the last couple of years really struggle. This is going to encourage development within Canada, which is a good thing as we do need more housing. Looking at a live example and taking into account these new rules, previously a mortgage of $500,000 at a rate of 4.5% with a 25-year amortization would come out to around $2,767 a month. Now that same $500,000 with a 30-year amortization drops to $2,521 a month. Looking at a $1 million mortgage with a 25-year amortization and a 4.5% rate, your payments would have been $5,534. Now taking that same mortgage and stretching it out to a 30-year, your payments drop nearly $500 or 10% to $5,042 a month. Short term, that obviously makes it a lot more affordable for Canadians to get into housing. Again, just remember that long term you are paying more interest and it's going to take you longer to pay off that property. So you really have to ask yourself what your long-term plans are and make sure that you don't overextend yourselves. Because while this is good to get into the market or maybe upsize to something that's better suitable for your lifestyle, it can be tempting as well. So just keep that into account and talk to your financial advisor or your mortgage broker to really make sure that you're setting yourself up correctly. So as we can see, lots of changes coming to the Canadian housing market, and just in time to ramp up for the 2025 real estate market, which the way that everything's going should turn out to be a pretty solid real estate market. We've got rates continuing to come down and these new rules making the barrier to entry easier for most Canadians. I hope you guys enjoyed this video. Please hit the like and subscribe button below. And again, if you have any questions about real estate specifically in your neighborhood, you can click the link in the description below to book a 30-minute call with me. Thanks so much for watching, and I'll talk to you soon.